Interest rates are a crucial part of our financial lives. They determine how much we pay to borrow money and how much we earn on our savings. When you take a loan, the interest rate dictates how much extra you pay over the life of the loan. On the flip side, if you're saving money in a bank, the interest rate tells you how much your money will grow. So, whether you're a borrower or a saver, interest rates impact you directly. We often hear about interest rates in the news, especially when the Federal Reserve makes changes. These changes can affect the entire economy, influencing spending, saving, and investing behaviors. That's why it's essential to grasp what interest rates are and how they work. Interest rates have a long history that dates back to ancient civilizations. In ancient Mesopotamia, interest rates on loans were typically high, reflecting the risk of lending money. Over centuries, societies have developed more sophisticated financial systems. During the Middle Ages, the Catholic Church banned usury or the charging of interest on loans, although this changed over time. In the modern era, the history of interest rates is closely tied to the development of national banking systems. For instance, the establishment of the Bank of England in 1694 marked the beginning of more controlled interest rates. Governments and central banks began to play a significant role in setting and regulating rates to manage economic stability. Over the last century, interest rates have fluctuated due to various economic events. For example, during the Great Depression, interest rates were kept low to encourage borrowing and stimulate the economy. Understanding this historical context helps us see why interest rates are such a powerful economic tool. Central banks play a pivotal role in managing a country's interest rates. In the United States, the Federal Reserve, often referred to as the Fed, is responsible for setting the benchmark interest rate. This rate, known as the federal funds rate, influences all other interest rates in the economy. The primary goal of the Fed is to maintain economic stability by controlling inflation and promoting employment. When the economy is sluggish, the Fed may lower interest rates to encourage borrowing and spending. Conversely, if the economy is overheating and inflation is rising too quickly, the Fed might raise interest rates. Higher rates make borrowing more expensive, which can slow down consumer spending and business investments. Central banks use a variety of tools to manage interest rates, including open market operations. By understanding the actions of central banks, individuals can make more informed decisions about borrowing and investing. Lowering interest rates can have widespread impacts on the economy. One of the primary effects is on consumer spending. When interest rates are low, borrowing becomes cheaper. This can lead to an increase in loans for houses, cars, and other major purchases. With lower monthly payments, consumers have more disposable income, which can boost overall economic activity. However, there are also potential downsides. For instance, lower interest rates can reduce the return on savings accounts and other fixed income investments. This can be a disadvantage for savers, particularly retirees who rely on interest income. Additionally, lower rates may lead to higher levels of debt as consumers take on more loans. Another consequence is the impact on investment markets. Lower interest rates can drive investors to seek higher returns in riskier assets, such as stocks and real estate. This can inflate asset prices and potentially create speculative bubbles. Moreover, lower interest rates can affect the currency's value. Thus, the effects of lowering interest rates are complex and far-reaching. Are you finding this information valuable? If so, don't forget to subscribe to Financial Fitness Hub, hit that like button, and share this video with your friends so they can stay informed too. Your support helps us keep bringing you the best financial insights. Impact on bond yields and currency effects. Interest rates have a direct impact on bond yields. When interest rates fall, the yields on existing bonds decrease. This is because newly issued bonds will have lower coupon rates, making older bonds with higher rates more attractive. As a result, the prices of existing bonds go up. This inverse relationship between interest rates and bond prices is fundamental to bond investing. For investors, this means that in a low interest rate environment, bond investments may offer lower returns. However, bond prices themselves can appreciate, providing capital gains. Currency effects are another critical consideration. When a country's interest rates are lower compared to others, its currency tends to depreciate. This is because lower rates offer less attractive returns for foreign investors who may move their capital to countries with higher yields. A weaker currency can boost exports by making them cheaper on the international market. However, it can also make imports more expensive, impacting inflation. Understanding these currency effects helps individuals and businesses make informed financial decisions. Speculative bubbles and market reactions. One of the risks of prolonged low interest rates is the creation of speculative bubbles. When borrowing is cheap, investors may flood into markets seeking higher returns. This can push asset prices to unsustainable levels. Real estate is a common area where bubbles can form. Low mortgage rates can lead to a surge in home buying, driving up prices rapidly. Stock markets can also experience bubbles. With low returns on savings and bonds, investors may turn to equities, pushing up stock prices. This can create a disconnect between stock prices and the actual value of companies. When the bubble bursts, it can lead to sharp declines in the market, wiping out significant amounts of wealth. Another concern is the impact on financial stability. Low interest rates can encourage risky lending practices. Understanding these risks is crucial for both investors and policymakers. Choosing the right interest rate for loans. Choosing the right interest rate is essential. Loans come with either fixed or variable interest rates. Fixed-rate loans have an interest rate that remains the same. This provides predictability in monthly payments. Variable-rate loans have interest rates that can change. These rates are often tied to a benchmark rate. Variable rates can start lower, but may increase. Consider your financial situation and risk tolerance. Selecting the best interest rate for investments. Interest rates play a significant role in investment decisions. Low interest rates mean lower returns on savings accounts and bonds. This can lead investors to seek higher returns in stocks, real estate, or commodities. Diversifying your portfolio is crucial in a low interest rate environment. Balance risk and reward when chasing higher returns. Stocks offer higher returns but come with greater volatility. Real estate provides steady income, but property values can fluctuate. Consider your investment time horizon and risk tolerance. For long-term goals, a mix of stocks and bonds provides growth and stability. Conclusion and further learning. Interest rates are a fundamental aspect of personal finance and the broader economy. They influence everything from borrowing costs to investment returns. Understanding how interest rates work and their impact can help you make more informed financial decisions. Whether you're taking out a loan or investing your money, paying attention to interest rates can save you money and increase your returns. Choosing the right type of interest rate for your loans and diversifying your investments are key strategies in managing your finances effectively. Follow news about central bank policies and economic trends to anticipate changes in interest rates. By understanding interest rates and their effects, you can take control of your financial future and make decisions that align with your goals and risk tolerance. If you liked the video, don't forget to subscribe to Financial Fitness Hub, give us a thumbs up, and hit the notification bell so you never miss another wave of financial insight. Let us know in the comments what topic you'd like us to explore next. Thanks for watching, and we'll see you in the next video, fellow financial navigators.